Hi, this is Terry. We're going to get started again with Chapter 4, and I want to go through the accounting conventions. So the accounting conventions was part of the conceptual framework that at one point in time the FASB tried to come up with a means that no matter what happens, everything had to fit within this conceptual framework. And the conceptual framework is just a totally abstract concept of how accounting should be. So as we go through these terms, you'll notice that they really are abstract. The first convention is comparability and consistency. So in making any future rules, part of the issue is that financial statements need to be comparable not only from year to year, but from one company to the next company. And the consistency issue comes into play, for example, like using FIFO or LIFO, that whatever method you use for valuing your inventory, even if FIFO would be better than LIFO or weighted average or any of the other inventory valuations, the issue is as long as you consistently use the same system month by month, year by year, then the numbers that you generate would be sufficient for investors to make good decisions. Materiality is not a dollar amount, so again, that's abstract. So if you turn to somebody and say, is $50,000 a material amount to a mom and pop grocery, the answer would be absolutely. But if you're talking about Microsoft having a $50,000 mistake, it would cost them more than $50,000 to go find the mistake. So the answer is no, $50,000 wouldn't be a material amount. So the way that materiality is defined is if the investor would make a different decision because of this new information, then yes, it's a material amount. If the information wouldn't change the investor's mind, then it's not material. Conservatism is all about making choices. Multiple times there'll be multiple rules that come into play, and you don't know which one to choose from. So the answer is whichever one least overstates your asset or least overstates your net income, then you would choose that. So for example, if you had two appraisers come out and appraise a building, and one appraised at $100,000, the other one appraised at $110,000, then conservatism would say, because it's an asset, then take the appraisal for $100,000 and be conservative. Full disclosure means that every material amount must be disclosed in the financial statements. And if it's not formally put into the financial statements through a journal entry, then it must be included in the notes to the financial statements. So for example, if your factory burnt down, is that something that you would journalize and would you let people know what's going on? Well, if you've got 20 factories and you can shift all your production to, you have enough excess capacity, you can shift your production to other factories, you wouldn't even bother to let people know that one of your factories burnt down. But if you only have 2 factories and you're not going to be able to fulfill your orders, absolutely, then that has to go into the notes to the financial statement. And cost benefit is that it shouldn't cost you more to gather data than the benefit that gathered data would give you. So cost benefit principle kicks in. For instance, SFAS 106 is about post-retirement benefits. It's about health care benefits. And you have to calculate your health care benefits. You have to know who smokes, who's married, who drinks, et cetera, so you can calculate how much money you need to put in a pension fund. And the issue is for some companies it would be so costly for them to gather that data that they actually don't have to do it, that they can just find a similar company and use their calculations. The next area is about the classified balance sheet, and the two big remaining parts to this chapter is the classified balance sheet and the multi-step income statement. They're very complicated, so take some time and walk through this. What we're looking at, and I'll see if I can't get most, if not all of it on here, is that what we're doing is, for a classified balance sheet, we're just going to take the income state or the balance sheet, and we're now going to put it in different categories. So the first category that we're going to use is current assets. And current assets, by definition, are assets that are going to be converted into cash within 1 year or one operating cycle. So cash is already there, the investments will be sold, accounts receivable will be collected, inventory will be sold off, prepaid expenses will be consumed, prepaid expenses being like prepaid rent, prepaid insurance. So these are all the items that within 1 year on one operating cycle is going to be converted into cash. So these are current assets, or they're also short-term assets. The other three categories, investments, property, plant, and equipment, and we'll have to arrow down here just a little bit. There's no intangibles on this one. So investments, property, plant, and equipment, and then there would be another category here, which would be intangibles. So we'll just write it in. These are all long-term assets. So these are assets that will not be consumed within 1 year or one operating cycle. Investments amounts to, and let me move this so it erases. Investments are going to be typically securities that you have in other companies. So companies like Chicago Tribune would own forests, and they would own paper mills, because you need forests to get the wood pulp, and then you need the paper mill to convert the wood pulp into paper so they can print the Sunday Chicago Tribune. They may do that also just to get better prices, or they may want to help control the market. Sometimes the investments are used as a means of a sinking fund, and a sinking fund is where you keep putting in securities so that when a long-term liability comes due, then you take those investments and sell them off to pay for the long-term liabilities. So if you've got a bond that's going to come due in 20 years, you just have a sinking fund where you keep putting money in the investments and playing the stock market so that when it comes time to pay that liability, you can. Other companies will just do the investment and play the stock market because they have excess cash, and they're just gambling. They're just trying to get a high return on their excess cash. Property, plant, and equipment mostly will be items that are subject to wear and tear. The exception, of course, would be land. So there's where we'd put in our store fixtures, we'd put in our equipment, we'd put in our buildings, etc. All of those items then, because they are subject to wear and tear, have a contra account called accumulated depreciation. So what we want to do is keep the historical cost, then this accumulated depreciation is just exactly what it says it is. It's a depreciation that's accumulated over time, and the net value then becomes what we call the book value or the carrying value. Collectively then, you put these all together and we get our total assets, in this example, $1,083,800. If I arrow down, because this is the balance sheet, then our total liabilities and owner's equity also has to equal that amount. So we'll arrow up just a little bit here and see that we have two major sections for our liabilities, and that's current liabilities and long-term. So the current liabilities, by definition, are current, so they're operating, and these are bills that we're going to pay within 1 year or one operating cycle. So notes payable, accounts payable, taxes payable, interest payable, all of those items. The short-term notes payable, sorry. The long-term liabilities then would be bills that we're not going to pay within 1 year. It's going to take us more than 1 year. And, of course, more of the classics is going to be mortgage payable and, of course, bonds payable, the chapter that every student loves to get in accounting. The other two sections, then, that we're going to see will be in the major sections will be in the stockholders' equity, and that's contributed capital and retained earnings. The contributed capital represents original investment. Original investment. And the retained earnings is exactly what it says it is. It's the earnings that we've retained in the business. So by definition, the retained earnings is an operating issue. It's how you're going to generate your equity from running your business as opposed to increasing your equity by having people buy into your business. Once we have made these distinctions here, and let's go back up and just review them real quick. We got current assets, investments, property, plant, and equipment, and intangibles. The intangibles were goodwill, copyrights, patents, those kind of issues. Anything that's a long-term asset that doesn't have a physical substance. So McDonald's Golden Arches is their trademark. So that becomes an intangible asset that's amortized over time. Again, so current assets, investments, property, plant, and equipment, intangibles. Then we have current liabilities, long-term liabilities, contributed capital, and retained earnings. Once we get all those items, then we can turn around and run all these different liquidity ratios. And the liquidity ratios are going to be about a way of measuring how well a company's doing. So if we take the first one, working capital, and say current assets minus current liabilities, that issue is it gives us a dollar amount that if we took all of our current assets, converted them to cash, and then took all our current liabilities and paid them off, how much money would we have left over? So the company that would have, $1,800,000 left over, is that good or is that bad? Well, you'd look and see what dissimilar companies match, what's their working capital, and then also compare yourself from 1 year to the next. How much working capital did you have last year versus this year? When we look at current ratio, then current ratio is the same thing, but it's divided. It's current assets divided by current liabilities. So if you get something like 2.15 to 1, that means that you have $2.15 for every dollar that you owe. So you have $2.50 that you could pay off every dollar you owe in the current time period, which means 1 year, one operating cycle. And again, these ratios, that's part of that consistency issue that we were talking about being abstract. If you just keep track of these ratios and then month by month, year by year, you calculate them and see what they are, then you can see how well a business is doing. Profit margin is net income divided by sales. And I put in parentheses strength because that's how well you can keep your expenses down to get the most profit. So if you have a 7 cent profit margin, or 7% even, that means 7 cents on every dollar is what you have, that's your profit, that's what you've made. And the more you can keep your expenses down, the higher your net income, the higher this number will be. The asset turnover, then, is the efficiency. So it's saying for the sales that you generate, how much assets do you have to tie up to generate that amount of sales? And that concept, then, is how efficient are you at using your assets to generate sales? The next one here, then, return on assets, is actually, and I'll slide down a little bit so I got a little room to write here. If you take net income over sales times sales over your average assets, then this is your profit margin. This is your turnover that we just talked about. So your strength times your efficiency, and that's called your return on assets. This is also known as the DuPont formula. And where this comes into play is, let's say that we have Sears and that we have Walmart. So maybe Sears makes 8 cents on every dollar and Walmart makes 6 cents on every dollar. Sears is selling durable goods, so they're selling, furnaces and microwave ovens and, items that you don't buy very often. Where Walmart is selling what's called consumable goods, those are goods that you replace, day in and day out. I mean, if you stop and think about it, how many times a year do you go to Sears? How many times a year do you go to Walmart? Sears then may only churn their inventory twice, where maybe Walmart churns it 5 times. So if you take your strength times your efficiency, 2 times 8, that's going to 16% for Sears, as opposed to Walmart, 5 times 6 is 30%. So who's actually doing a better job? The 16% return on your assets or a 30% return on your assets? So most people would say that Walmart's doing a better job from a financial standpoint, and that's the whole concept of a discount store. The discount store doesn't make as much profit on the items that they sell. It's the fact that they churn their inventory so many times. So that's, let me slide this to get rid of it. That's what this whole section here is about. The next item is debt to equity ratio. And what you do is look at your total liabilities and your total equity. And so maybe you get a 50 million in liabilities, 50 million in equity. So you have a 50-50 ratio. Well, that's the whole concept of leverage. How much are you using of other people owning your assets? Remember that's our owner's equity here. Remember, that's our definition of liability. Liability is our debt. That's what we owe other people. So different companies will have different percentages that are reasonable based on what their product is that they sell, their goods or services they sell. So banks, this would be higher. And it would be higher because for when you deposit money into a bank account, then you are a liability to them because your account is a demand deposit. At any point in time, you can walk in there and demand to get your money back. So to a bank, you're a liability. That's what your cash is to them. They're going to record that they receive cash, but record that they owe you the cash. That's the liability part. When you start getting these numbers higher, 60-40 and 70-30, then the issue is you become highly leveraged. There's a lot more risk. And people, just don't like to lend you money when you're high risk. If you go the other way and you're 30-70, 20-80, then that's also an issue because you might be missing opportunities where you should be taking your money and expanding your business and getting greater market share. So it's just a matter of keeping track of all those numbers, comparing them to the economic times. We have a presidential election coming up all the time. You just have to take everything into consideration and make those decisions. What's a good number? It's whatever's good for the time and the company and the business that you're in. And the last one that's here, and we'll again move this to get rid of all our little red, is return on equity, which is net income over the average stockholder's equity. And anytime you see average, what they usually do is they just take the January 1st beginning balance, add it to the December 31st balance, and divide by 2. So return on equity is net income over average stockholder's equity. And that's what people are looking for, the money that they invest in your company. What kind of return are they getting on that investment? And so I put a nifty little chart here just so it looked pretty. Okay. The next major concept then is the idea of a multi-step income income statement. So, and this is just a bear. I mean, it just is. So we're going to have it in greater detail in the next chapter. So I'm not going to go into it extremely deep, but it's the idea that before we just had revenue minus expenses is net income. Well, now it makes more sense to break this into larger categories. So we're going to have sales minus discounts minus returns and allowances, and then that will give us our net sales. The cost of goods sold section is going to be beginning inventory plus our net purchases is goods available for sale minus ending inventory is the cost of goods sold. Don't worry about this part right now because that's the push in the next chapter. So just realize that sales minus the cost of goods sold is gross margin. Then when we separate out our operating expenses, which subdivide into selling and general and administrative here, then we get how much income we got from our operations. Then we have other revenues and expenses, other gains and losses, and ultimately, if I arrow down here, then we'll get income before taxes, subtract our taxes, and come up with net income. So this is a much more segmented income statement than what we had in the past, because in the first couple chapters we're just struggling trying to understand what an income statement is. Each one of these, because they're now segmented, has significant meaning. This gross margin is once we subtract what it cost us to buy the product that we're selling, this is how much money we have left over to run the rest of our company. So if we were in a restaurant and our food cost was 35% and our net sales is 100%, we've got 65% to run the rest of our company. So it's looking at those percentages and this how they're subdivided that becomes significant. Then we can look and say, okay, our selling expenses, what is that in terms of a ratio of our sales? So what percent of our sales goes to selling expenses? What percent of our sales goes to general and administrative? Those kind of issues. So when you do some comparisons, which again is a later chapter, it's the fact that we put it in this format that we can do that type of analysis. Don't forget to look at the end of your chapters to the comprehensive problems. This chapter, and especially the next chapter, Chapter 5, when we talk about inventories, they're all very good at explaining and giving you some practical experience at the concepts in the chapter. All right, I hope this is helpful. Again, keep me posted and let me know.